Hey everyone, happy September. It's Thursday, September 1st on the Final Hour. We're going to talk to Mike Schell from Schell Capital Management, the S&P managing to end the day in the green. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in a sunny and warm Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts, using the technical analysis toolkit, the best practices of technical and behavioral analysis to make sense of these markets. Pretty keyed up earlier in the day around lunchtime Eastern, talking about this continued push to the downside, and while the bear trend certainly appears to still be in play, the S&P managing to finish in the green along with the Dow. We'll look at those charts here in a little bit. Just to let you know about what's upcoming here. Excited to talk to Mike Schell here for the first time in a short while. Next week, we have Monday off for the market holiday. So Tuesday, we'll do our normal Monday show where we break down the market from all three directions. We have Joan Kosar from Asbury Research on the 7th, on Thursday, the 8th, Hema Reddy, joining us for the first time. She's an expert in GAN analysis. And then the week after, Dave Landry of DaveLandry.com joining us on Tuesday, the 13th. Also, ChartCon 2022 is happening. We're about 5 weeks out from the technical analysis event of the century. If not that, certainly 2022. We are hosting our first ChartCon since the pandemic began. We're really excited to bring that event back. We have about 20 presenters we are bringing to our Redmond, Washington's brand new studio. We will be highlighting their expertise. I was chatting with Jeff DeGraff earlier today, who's going to be on a pilot panel. I have Jeff DeGraff and Tony Dwyer, both of which are successful private pilots. They fly all over the place and also are incredibly knowledgeable and capable market strategists. We're going to talk about that relationship between flying and investing because there's a lot of overlap. That's just one of the great conversations you're going to be able to access. Go to StockCharts.com/ChartCon for all the info. You can sign up for that event there, and there are special perks and special prices for members. So make sure you join. And if you're not a StockCharts member, it's a great time to take a free trial so you can access all of that special members-only content. Let's continue on today's show with our market recap. As I mentioned, sort of a distribution phase, through the course of the last week or two. But today, obviously, rotating higher and accelerating to the upside into the close. The S&P, the major averages have sort of been weakening in the last 30 to 60 minutes most days recently. That's sort of one of those markers of a bear market phase. You have a lot of distribution going into the close. It tends to be when institutions are operating. That's when you have ETF rebalancing and such. So we're certainly seeing the opposite of that today for what it's worth, with the S&P finishing back in the green. Bounced almost to the 3,900 level. So I'm sort of warming up my discussion of what happens once we hit 3,900, because we've talked about that as a potential downside target. Turning around though today and moving to the upside. The S&P finishing up about 0.3%, just below 3,970 at the close. The Dow a little bit above that, about 0.5%. The NASDAQ composite down about 0.25%. The VIX actually pulling back a little bit and finishing the day around 2540. Now, earlier in the day, it was up in the 27s, really rotated to the downside. So you had volatility come off as stocks rallied in the afternoon, really going higher into the close. Other asset classes here very quickly. One very important theme is a continued rise in interest rate. Don't look now, but the 10-year yield around 326. We're now right back at the level, the peak that we were in 2018. We talked on the way back up from the lows. How far? And it's so funny when the 10-year yield's like at 0.5%, 0.8%. 3.25 seemed like this unrealistic, ridiculous target that you would never actually say out loud. We're there. And now, again, we're testing those highs. We got a little bit higher earlier this year in June. The question is, do yields go higher? And if so, what does that mean for growth versus value? What does that mean for the major averages, which are obviously fairly growth oriented? What does that mean about the overall risk appetite for investors? The dollar index, by the way, also moving higher. through the course of the day. I'll tell you one thing that is consistently not moving higher: gold and precious metals. Even when other things are going up and going down, gold seems to have one direction, and it seems to be not up. You see gold, the GLD down about 0.9%. Silver down a little bit as well. The broader commodity complex weaker as well. And that's an interesting sort of shift in the last couple sessions where we see energy at the bottom of the list. We're used to seeing kind of everything down and then energy, maybe materials at the top. Now we're seeing the reverse of that, where energy materials are actually rotating to the downside. Industrial is one of the worst performers as well. That's called we call those the MEI sectors, sort of those late cyclical sectors, which for what it's worth now, rotating into a weaker relative position. Cryptocurrencies, I would say noisy and mixed, with Bitcoin down a bit, Ether up a bit. In the end, not a lot of movement. And by crypto standards, this is actually a pretty mild day, less than 1% on some of the major coins that we would track. But Bitcoin continues to chop right around that 20,000 level. We've talked about that many times, about how big round numbers tend to have meaning. And there's academic research that shows why that happens. A lot of times investors just place orders right around big round numbers because that's where you just sort of naturally revisit a thesis. That's when you think to take profits or manage risk. If you're going to set a stop, a lot of times that's where people kind of cluster them. And as a result, things move there. Bitcoin has been all around 20,000 for quite some time now. And I would keep that level on your radar if you're looking at cryptocurrencies. Just briefly looking at a chart of the S&P as we continue our market recap, sort of the open, lower, close higher kind of move. So we opened lower than yesterday's close, around 3930, traded down to 3900, closing back to the upside. So you could consider today the first test of that 61.8% retracement. As a reminder, that's taking the June low, the August high, where we tested the 200-day, and that was sort of it, right? Then we take 38.2% of the way down, is around 40.60. Breaking down through that level, for us at least, was an indication, kind of a confirmation that the uptrend is at the very least on a big pause, and at worst, this is the beginning of something a lot more deep and more sinister. The fact that we've now bounced off of that 61.8% retracement is interesting. And Julius de Kempener was writing about this earlier this week. I remember in his blog, I think on Tuesday, he posted something on that 3,900 level, which I totally would agree with. My question for all of us is, what happens if we go below 3,900? What if we finish the week tomorrow closing below 3,900? What does that tell you about the overall conditions? What downside targets would that naturally open up in terms of possibilities for you as you're thinking about this broader market environment? Let's also look at the momentum, right? The RSI and the S&P is below 40, and a lot of times in a bull market phase, kind of the whole range of the RSI moves higher, which is why when things are bouncing higher, I like to see if they reach an overbought condition. And then on a pullback, which is natural in any phase, you get a pullback, a counter trend move. Where does the RSI go? And the fact that we've gone below 40 now and kind of remaining there tells me this is weaker rather than stronger. This is weaker, what I call internal momentum for the major averages. Looking elsewhere, two of the sectors actually having a pretty decent day. Healthcare up 1.6%. Now that's interesting because recently some healthcare charts have looked pretty bad, right? I'm thinking of things like Biogen, and some of those have been struggling for a little while now. But you're seeing some short-term weakness. It's actually the number one sector today. While the S&P managed to squeak out a minor gain around 1/3%, healthcare up 1.6% using the XLV. The utilities sector up 1.4%. So seeing some strength in those two areas of the market. Here's the problem. Utilities, in my opinion, is decent for one thing, and that's probably oversimplifying, and apologies to all utility owners and things, but it's usually, as an investor, it's good for defense. It's good to hide out. It's good to ride out periods of market uncertainty. I know from my time working with institutional investors, you would own utilities when you're trying to hide somewhere and wait for a period of instability, certainly a bear market phase to sort of play out. The reason is because it's relatively low volatility, so you have a lot weaker price swings in general than the overall market, right? Lower beta. Which is why the low vol ETF includes a good amount of utility exposure. Also tends to pay a higher dividend than the S&P, than the average stocks as well. So you have an income component, you have the ability to ride things out. And the utility sector is making a new multi-year relative high today. So when utilities are making a new high, I have learned to not get too excited about market upside, because that tells you there's, again, big institutions, from my experience, own utilities for one reason, and that's because they don't want to take on risk that is clearly inherent in other parts of the market, particularly growth areas of the market. So in terms of a general cautionary signal, I think that could certainly be one of them. On the bottom side, as I mentioned, materials, energy, industrials, sort of those cyclical sectors at the bottom. Technology as well, down 0.5%. Now, one stock obviously to hit, sort of NVIDIA, AMD were in the news, gapping lower. And I'm often asked in this sort of environment, just to wrap up our market recap, I'm asked when there's a news-driven move like this, why do charts matter? Why would you even look at a chart? This is just a news event. This is related to, their ability to sell chips in China and just sort of regulatory issues and how they work through it. At the end of the day, I have learned that the chart, not that it's immune to news, but it reflects what investors are thinking about. It reflects what investors are doing as anticipating potential news and reacting to potential news. So I would say charts are vital in this sort of environment, because regardless of what causes the price to fluctuate from 150 to 140 to 130, it tells you what's actually happening. How are investors voting with their feet? That's what the price tells you. And in this case, it's telling you for some key semiconductor names, they're voting down rather than up. Let's take a quick commercial break. We'll be back with today's guest, Mike Schell. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close. Couple quick announcements before I bring on today's guest, Mike Schell. First off, we welcome your questions. We'll do a mailbag segment on tomorrow's show on Friday. We'd love to feature one of your questions live on the air. Our email is thefinalbar@StockCharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. I'm so proud of the Stock Charts TV team, providing fantastic content from a great suite of guest contributors, and also fantastic guest experts like Mike Schell and many others. All of that is available for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Mike Schell. Mike's the president of Schell Capital Management, coming to us from Florida, from the Tampa, Florida area. Mike, it is a pleasure to have you on the show. Welcome to the Final Bar.
Glad to join you, Dave.
So I appreciate you sending some of your charts ahead of time. We're going to start with the equal weighted S&P. You and I were talking before we went live today just about this, this shifting market, a choppy market going up, and now in the last couple of weeks, really netting out to a negative move. Help us make sense of this market from your eyes. What are you seeing?
Well, it's a bear market. The stock indexes have been down all year. We're probably going to see a lot of swings up and down as it goes. You can see there's lower highs, lower lows. I'm looking at the equal weight there index here just because it equally weights all 500 stocks instead of cap weighting and mostly on the upside on the Teslas and the Microsofts. And as you can see there, it's getting down to the lower end of the Bollinger Band. So more importantly, though, is the relative strength below that. During sideways or choppy markets like this, your relative strength index is going to point you to overbought and oversold. You can see it was actually overbought a week or two ago, and now it's starting to get oversold again. You have to be a little bit careful because obviously what goes oversold can get a lot more oversold in a bear market. However, you just need to be prepared for lots of swings. The percent of stocks in the S&P that are above their 50-day moving average had really gotten up to 90% and stayed there. In a bull market, it'll typically stay up in that higher range above 50. Now you're down to about 42% of the stocks in the S&P are above the 50-day moving average. And then the 200-day moving average, much slower moving. Overall, though, notice that they're both in downtrend, or the 200-day one is in downtrend along with the index. The 50-day obviously is going to be a lot faster moving. So I anticipate we're going to see a lot of these swings, 10, 15, 20%, until this bear market is resolved.
It's a great chart. It's so interesting to see literally half the S&P was above their 50-day and now back below it, right? Thanks for highlighting that. Your next chart is looking at the VIX volatility, certainly a big part of the story in 2022. What's your read here?
So for the last 25 years, I focused on price trend, momentum, relative strength, volatility. And here we got the volatility index, which I've been monitoring for 20 something years since it's been out. And, basically, implied volatility is pointing to a volatility expansion. And when you get up into the above 20, it's 26, looks like right now, that's telling you over the next 30 days that the S&P is probably going to swing around 1.6%. So the volatility that we're seeing is very normal. So you can use the VIX index to kind of let you know what the market is pricing as a normal range. And so this 1.5, 1.6% daily swings is within a normal, trend. So.
Yeah, thanks for connecting. I know a lot of people don't really think about what that actually means for the S&P. Thanks for explaining that a little bit. It's actually pretty helpful. Now, interest rates, obviously big time on the move now back to the levels in 2018. What's next for rates from your perspective?
Well, that's part of the problem here is that as this, as the 10-year rates are going up, that's going to, it's putting pressure on everything else except for the dollar. The dollar's kind of wanting to follow it up. But, as interest rate, the big issue we have right now is, whether or not this is a bear market and we're going to have lots of swings, cyclical swings up and down. But the thing is right now is whether or not we go into a recession. Most historically, prolonged bear markets are caused or created within recessionary periods. It looks like we're probably going to see a recession over the next 12 months because you got the 10-year 2-year spread is inverted. So is the 530. So that has a very reliable predictive ability into recession over the next. The only problem is that it's usually like 6 to 18 months. So it's a very early warning sign. But obviously as rates go up, that's putting a lot of pressure on a lot of other things, bonds and stocks.
So we only have about 30 seconds left, Mike, but I'd love to know, given this sort of environment and given the idea that you're talking about sort of a recessionary period, the prospects of a bear market, where do you look for opportunities in this sort of thing? Are there places where you see opportunity, or is this a time to just get defensive and wait?
Well, I trade the swings mainly across stocks, bonds, commodities, and currencies. Just focus on the swings because there's going to be plenty of them as opposed to trend following. I become a little more counter trend trading oriented as opposed to just following the trend.
There's a lot of wisdom in that approach. We all may become swing traders before 2022 is all said and done. Mike, listen, it is such a pleasure to meet you virtually. Thanks for coming on the show. We'd love to have you back again, but stay safe there in Florida. We'll talk to you again soon.
Okay. Thanks, Dave.
That's Mike Shell. Mike's the president of Shell Capital Management, coming to us from Tampa, Florida. I love his charts. He sent me some great examples on StockCharts about some of the things he was looking at. And when we were talking earlier, the first thing when I chatted with Mike a little bit ago and just asked him how he was doing and what his perspective was, his answer was, well, we're in a bear market. And the simplistic answer to just taking all of that stuff and thinking about just the overall trend, where are we at in this phase? And then using that as a basis of your approach, but using the foundation of the evidence. And as I was talking with Mike, we talked about what charts he was going to share, going through stocks and volatility and interest rates. And we didn't get to some of the charts he had shared about the dollar and some other things, but I thought that was a really good way of walking through. It might be a good idea to think a little more short term and play the volatility, which certainly is one of the few things that appears to be going higher. Great take there from Mike Shell at Shell Capital Management. Let's continue on today's show with our next segment, Getting Sentimental. What we like to do is check in on some of the sentiment data. We have a great amount of sentiment data on the StockCharts platform. What I would encourage you, if you're just learning the platform and trying to learn how to analyze some of the sentiment data, these charts that I'm going to show you are part of my chart pack that is available to StockCharts members. So you can use all of these charts pretty much exactly how I'm showing them, save them to your own login, customize them, share them with your friends, do whatever you want. The way you find those, by the way, is when you go to your dashboard, you'll have your chart list. At the very bottom of your chart list, you have a little gray button that says Manage Chart Packs, and you'll find my chart pack on there. You are more than welcome to access it. Let's go through the sentiment charts here very quickly. We'll start with the VIX, and I thought Mike did a great job. And what we don't talk about often is the fact that the VIX actually is an implied volatility of the S&P 500. So it basically tells you what percent swings to kind of expect, like what would be reasonable based on the volatility, based on the options market, is what it's essentially telling you. But what I love to do is just think about what the chart has done relative to the S&P. Now, there's a known and widely covered inverse relationship, generally speaking, where markets tend to go higher and volatility tends to be a little lower. When markets bottom out, volatility tends to be very high. When markets top out, when they reach a top, the volatility is usually very low. And I think the reason why I explain it's sort of that classic, the markets take the stairs up or take the escalator up, but the elevator down, right? When people panic, they don't kind of gently panic and very slowly take some off the table. You panic and you dump everything, right? You do it quickly. And as a result, that's why volatility tends to increase. There's uncertainty. So it's often called the fear gauge. I think the uncertainty gauge is probably a better description of what it's actually telling you. So how has that actually played out in the last 8 to 10 months? Well, we talk about volatility regimes when I talk about the VIX. And if you look at it, these horizontal lines, these shaded areas show you essentially the range on the VIX starting last November, December, and then going through the course of this year and continuing to stay true. When the VIX gets down to 20, that has been pretty much every major market peak, except for the June one, where the VIX actually stayed a little bit elevated. That's fair. But the rest of these ones in January, in March, and then in August, VIX got down to right about 20. When the market has sold off, you see the volatility increases. When the VIX gets up to 30, that's where you start looking for a bottoming pattern. 35 has certainly been where a number of these have bottomed out. The VIX has topped out, and that coincides with a market bottom. So as we sell off, if you're trying to use this chart to think about where might a legitimate bottom form, I would be looking above 30, right? VIX gets above 30, that will have shaken out, at least based on historical trends in 2022. That's shaking out sort of all the bulls that are just sort of holding on to this buy on the dips thesis. When it gets up to there, that's when a lot of the panic, at least so far in this year, has sort of played out. So at this point, the VIX is sort of mid-range of where it's been. If we continue to go lower, which I think we may, I would look to see if the VIX gets up to that 30, 32 area. That might be a safe place to start to reconsider jumping back in. Looking at sentiment in terms of the AAII survey, a continued decline now in this survey data from 2 weeks ago. 2 weeks ago was almost net positive for the first time since March, although it didn't quite get there. Still about 3-4% bears outweighing bulls. Now that spread is all the way up to almost 30%. 50% bears, only 22% bulls. That's a widening gap, and now getting to some of the lower levels that we've seen so far in 2022. And if you look back in the deep history, a spread that wide is pretty significant. It's rare that we get down to 50% bears. Getting down to 60% bears is where we've had some bottom. So again, there's more room in this chart to get more bombed out negative. As I mentioned to my guest today, Mike Schell, we were talking about where the sentiment was very, very bombed out in June, right? That was one of the great signals, and Tom Bowley and others did a great job of highlighting that extreme negative sentiment, what that meant for the upside possibility. You had almost a reverse of that. We almost had this euphoric read in mid-August, which is some of the things we talked about on this show. Now we're kind of going back, but we're not down to bombed out sentiment again. I'm still seeing a lot of optimism when I'm hearing people talking about this is just another pullback and to get in. And I think the sentiment is telling you there's potentially more room to go to the downside. One chart I wanted to spend a moment on here is the name exposure index. Now I look at this weekly. It's actually a daily data set that we get, and it's a survey of money managers. It's the National Association of Active Investment Managers, and they are asked to respond with their exposure to equities, right? Are you 100, 200% long, 100, 200% short, or zero, kind of net flat equities? And then they aggregate that, and you get a net sort of percent of the aggregate group, and they're weighting to the equity space. Currently at 32%. If you look back to the left, we're just looking at the last 7 years or so, one of the lower readings that we've had. And when we got down to the lows in May, the low in June, we got down to around 20%. Back in 2020, we got almost down to net short, which is incredibly rare, but it has happened. I think the last time it was totally net short was back in 2009. I'd have to go to the tape. I haven't looked at that a little deeper history in a little bit. But certainly we're at some of the lower readings we've seen in 2022. But again, when the markets have bottomed out, even in this year, it's often gone down a little more than we've seen so far. Right about where we were at the February low, we're not down to the levels, which is another 12% below current levels. The REGN flows, by the way, continuing to increase, and this is plotted inversely. Meaning investors within the REGN family are rotating a little more defensive in the last couple of weeks. Now, that line had been going essentially steadily higher for about a 3-month period after being really bulled up there at the end of fourth quarter of last year. It was one of the lowest ratings that we've seen in the history of the data set. And all of a sudden, it's coming back in the last 2 weeks, causing some investors to go more to the defensive side of the REGN family. I didn't get a chance to update this annotation. So real time, you'll see me updating the annotations here. This is the put call ratio. You can see it's pushing higher here, getting near some of the highest ratings that we've seen, really going back to February, March 2020. That's when the levels spiked up quite some bit. There's an inverse relationship, just similar to the VIX with the put call ratios. This ratio tends to be pretty high when you get to market bottoms, tends to be pretty low when you get toward market tops. You can see it's accelerating, not to the top we saw in May and June, but certainly pushing in that direction. By the way, one of my favorite things to do on StockCharts, and I'll spend 30 seconds telling you this, is what I just showed you. I look at the sentiment data set randomly during the week, but every Thursday I bring this up and I update all the annotations. I put a horizontal line at the current level. So every week I have to go in here and update this annotation, which is a bit manual, but it really helps me to think about where these things are moving. And when I find every week I'm bumping the put call ratio higher, it tells me a lot about the underlying environment that I'm trying to analyze. So it's a good way to use horizontal lines to keep you updated on how these charts are evolving. The show's done. We need to wrap it and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. I mentioned in our market recap the utilities sector, and the XLU is an easy way to do that. I have a chart that I featured yesterday on the 3 and 3, which I simply call the chart. It has 5 metrics that are pretty easy to follow that I think tell you a lot about the overall conditions of the broader market and some of the things underneath the hood, things like the relative strength of semiconductors and also the relative strength of utilities. As I mentioned in the recap, the concern I would have here is even though the price is pulling back a little bit, the relative strength is making a new high. And what I found is particularly big institutions, you have one reason why you would want to allocate any of a fund to the utility sector. And it's if you want to get defensive, right? Think of a big mutual fund running a $10 billion fund. Your mandate probably, specifically if it's a standard mutual fund, you have to be fully invested or very close to that. You might have 3 to 5% of cash just to address any sales or redemptions. But overall, you have to be fully invested in the equity markets. And if you are, what happens when you think the markets are going to go down? Well, you have to get defensive. You have to go to consumer staples or REITs or something like utilities. So when utilities relative strength is improving, I don't tend to feel great about the prospects for offensive sides of the ledger in the markets. Chart number 2, Regeneron, REGN. I mentioned how healthcare was one of the top sectors. I think it was the number 1 sector today. When we talk about our market recap, I always like to highlight what I call sort of the candle alert, right? When you see a candle pattern that is worth highlighting. Regeneron had this great, what's called a shooting star candle when it broke above its 200-day moving average here in mid-August. This is when the S&P is testing its own 200-day. This candle in particular, you opened here, so opened lower than the previous day, traded all the way up above 650, and then closed right back at the lows for the day. That's called a shooting star, and it's a short-term negative candle. You can see what happened from there. Regeneron today, a bullish engulfing pattern, which is a down day followed by an up day. The body of day 2 engulfs the body of day 1. That's a short-term bullish signal. So it's actually telling you Regeneron should be higher over the next 1 to 3 bars. The low of today would be the natural stop that's built into that candle pattern. Finally, NVIDIA. It's interesting. We actually closed almost exactly at the July low, and that's what I wanted to highlight on this chart. So we have now traded down just below, but on a closing basis, we are basically testing that low from July. So while we made a new closing low, we've gapped lower. I'd be interested to see if you see buyers come in now that we're at the lower end of this channel. If so, it should make you feel a little bit optimistic as we're oversold and bouncing off support. But what happens if we fail? Charts like NVIDIA failing at support is not a good look for the broader market. Folks, that is our show for today. Special thank you to Mike Shell from Shell Capital Management joining us from Tampa. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.